Imagine for a second walking into this highly secure, incredibly quiet European Union conference room, right? Like somewhere in
Oh,
Brussels.
I can picture it perfectly, the whole aesthetic.
Yeah, exactly. It's just filled with policymakers in these tailored gray suits, and they're meticulously debating the precise legal definitions of industrial subsidies, international supply chains, that whole thing.
Very serious, very dry.
Right, but then right in the middle of that room, sitting cross-legged on this massive mahogany table, is just a group of chaotic day traders.
And rocket ship t-shirts, probably.
Yes, wearing t-shirts with rockets on them, frantically refreshing their brokerage apps and, screaming about taking their portfolio to the moon.
That mental image is, I mean, it perfectly captures the stark contrast in the stack of sources we're unpacking for you on this deep dive today. It's pretty wild.
It really is.
Because we're pulling from this incredibly dry, high-level policy document. It's an input report from Eurochambers regarding the upcoming European Chips Act 2.
Very bureaucratic.
Very. And we're pairing that directly with a crypto market briefing and a, frankly, highly enthusiastic emoji-filled Reddit thread from a retail investing forum called r/Inner Circle Investing.
It's just the ultimate whiplash, because what we're tracking here is how massive, slow-moving geopolitical policy shifts in Europe are violently intersecting with explosive meme stock level retail investing.
And it all centers entirely around the future of semiconductor technology.
Exactly. So, whether you're trying to understand the hidden vulnerabilities in global supply chains, or maybe you're looking for the underlying infrastructure trends powering the whole AI boom.
Or you just want to know how Reddit traders hunt down their next target.
Right. All those threads, they all tie together right here. But to really understand what these online traders are betting their money on, we have to look at the geopolitical chessboard they're analyzing first.
Yeah, because before any specific stock ticker gets spammed on a message board, the foundational rules of European manufacturing are being completely rewritten.
Because the first version of those rules basically failed, right?
I mean, effectively, yes. The original European Chips Act, according to the Eurochambers document, and, they represent over 20 million businesses across the continent, that first act was drafted right in the thick of the pandemic.
Pure panic mode.
Exactly. The core mission then was simply to raise Europe's share of global semiconductor production to a flat 20%. They just wanted a fifth of the global pie, period.
The European Commission was reacting to those severe pandemic-era supply chain shortages. The instinct was basically just manufacture more of absolutely everything right here at home.
But Eurochambers points out that this mandate severely lacked any real strategic depth. It was a volume game, and it totally ignored the structural realities of how this technology is actually built.
Reading through it, it really feels like the industrial equivalent of pandemic toilet paper hoarding.
That is, wow, yeah, that's exactly what it was.
Right. It was this knee-jerk reaction to the fear of empty shelves rather than, a calculated long-term strategy. When you look at the reality of the European semiconductor ecosystem, chasing a flat 20% global production share across literally every type of tech was just a massive misallocation of focus.
Oh, totally. And the dependencies outlined in the report make that painfully clear. Europe currently relies on outside suppliers for an estimated 80% of the materials and the tools needed by their semiconductor firms.
80%.
Right. And that supply chain routes heavily through the U.S., Taiwan, China, and South Korea. So, you can't just command a 20% global market share into existence when you literally do not control the raw inputs.
And the report gets incredibly specific about advanced nodes too, right? Like the ultra-powerful chips below 10 nanometers that run top-tier smartphones and massive AI models.
Yeah, the really cutting-edge stuff.
Right. Europe basically lacks any domestic manufacturing capacity for those advanced chips. But here is the crazy paradox. The actual domestic demand within Europe for those specific components is surprisingly low.
And that is such a crucial disconnect in their initial policy. Because, think about it, to justify building a $20 billion commercial mega foundry for those sub-10 nanometer chips, a region needs massive domestic consumer electronics manufacturers.
You need an Apple or a Samsung in your backyard.
Exactly. You need companies buying tens of millions of those chips every single quarter just to make the factory profitable.
Which Europe doesn't really have.
No, they don't have those consumer hardware titans. So subsidizing a mega foundry purely for local volume makes very little economic sense for them.
And the craziest part is, while they were hyper-focused on this unrealistic goal for the absolute cutting-edge stuff, they completely neglected the foundation of their existing industry.
Oh, the legacy components.
Yeah. The report highlights this staggering collapse. Look
Yeah.
at printed circuit boards, right? The basic green boards that hold the chips together in literally every electronic device on Earth.
You can't build anything without them.
Right. Well, in the year 2000, Europe produced 13.8% of the world's printed circuit boards. But today, that number has collapsed to just 2.2%.
It's an entire industry just hollowed out in 2 decades. And the report points directly at European trade policy as the culprit, which is wild.
It's totally self-inflicted. Because regulators maintain these high tariffs on the base materials needed to physically construct those boards. But at the same time, they allowed zero tariff imports on finished boards arriving from Asia.
So if I'm a European manufacturer, I am literally financially punished by my own government for buying the raw materials to build the product locally.
Yeah.
While my competitor just imports the finished product for free.
Exactly. The bureaucratic logic actively incentivized offshoring. I mean, they were trying to build the roof of this technological house with these advanced AI chips, while the foundation was literally being dismantled by their own tax code.
It's a mess. But that realization is exactly what's driving the massive policy pivot we're seeing now. Eurochambers is practically begging the EU to abandon that blind 20% volume target.
Right. They have a whole new catchphrase for it.
They do. The new terminology, the phrase that really changes everything here, is strategic indispensability.
Strategic indispensability. I actually love the framing of that. It stops being about sheer size and suddenly it becomes about leverage.
Yes.
Like, you don't need to make every single part of an airplane, but if you're the only country on Earth that makes the engine rotors, well, nobody can build an airplane without you.
That is the exact mechanism they're trying to implement. Europe needs to double down on what it already does better than anyone else. So we're talking manufacturing equipment, specialty chemicals, power electronics, sensors, and heavily photonics.
Which brings us to the upcoming Tech Sovereignty Package and CHIPS Act 2.0. The Eurochamber's input insists that semiconductors have to be officially classified as an essential security interest.
It's no longer just about, smartphones and PlayStations.
No, it's about aerospace, secure communications, national defense. And to achieve this, they are pushing for a completely different manufacturing strategy. They call it the lab-to-fab approach.
And this lab-to-fab strategy addresses a huge structural flaw in European tech. Instead of pouring all their available subsidies into 1 or 2 giant megafabs, the policy shifts to supporting much smaller, highly specialized facilities.
Right.
The goal is to physically bridge the gap between early-stage innovation, the lab, and commercial volume production, the fab.
So as a listener, if I'm a European startup with a groundbreaking new chip design, how does this lab-to-fab policy actually change my life? Because just having a great idea in a lab doesn't automatically put hardware on a shelf, right?
Oh, absolutely not. It targets what hardware engineers literally call the valley of death.
The valley of death. So dramatic, but so true.
It really is. I mean, think about software. In software, scaling your product to 1 million users might just mean renting more server space on AWS. It's relatively cheap.
Sure.
But in hardware manufacturing, moving from a perfectly working lab prototype to mass commercial production requires astronomical capital expenditure. You need access to a pilot line. You need specialized clean rooms, multi-million-dollar testing equipment, highly specific chemical supply chains.
And most startups just run out of cash trying to build all that, and they bleed out right there in the valley.
Exactly. Or they get bought out by a massive American or Asian conglomerate with deeper pockets. So the IP was born in Europe, but the physical manufacturing, the economic benefit, and the supply chain control, all of it ends up overseas.
Which defeats the whole purpose. But the crypto briefing we looked at highlights the sheer scale of the financial intervention designed to stop that exact scenario. They're talking about the Tech Sovereignty Package, proposing massive sovereign backing specifically, between 30 million and 500 million euros in financing facilities per company.
That is serious capital.
It is. But money alone doesn't actually solve the problem if it takes like 5 years for the bureaucracy to release it,
Oh,
right?
for sure.
And I notice Eurochambers is also pushing to aggressively shorten state aid approval times. They want approvals limited to just 6 months after a pre-notification.
Yeah, they are demanding a major expansion of the general block exemption regulation, the GBER thresholds. They want that expanded for smaller projects.
Okay, unpack GBER for us real quick.
So the general block exemption regulation is essentially a legal fast lane. Normally, when a European government wants to hand millions of euros to a private company, it triggers these intense, years-long anti-monopoly investigations by the EU to make sure competition stays fair.
Which takes forever.
Right. Expanding the GBER thresholds means these smaller critical tech companies can completely bypass those lengthy investigations and just get the capital immediately.
It's state-sponsored industrial security. They are building a heavily funded, legally fast-tracked bridge over the Valley of Death. So let's take this high-level, multi-million euro lab-to-fab policy, and specifically its heavy focus on photonics, and watch what happens when it actually hits the open market. Because this is where the traders on r/inner circle investing enter the narrative.
And honestly, the transition from the rigid bureaucratic logic of the European Semiconductor Board to the raw, speculative energy of a Reddit forum it's jarring.
It's amazing.
The crypto briefing highlights two specific companies expected to be massive beneficiaries of this exact policy, XFAB and SIVE.
Right, and SIVE, which is Sivers Semiconductors, has basically become the absolute obsession of this retail investing sub. I mean, looking at the numbers these users are posting, the leverage they're anticipating is staggering.
It really is.
One user maps out how Sivers is up 815% over the past year.
And a gain of 165% in just 30 days alone.
Which is insane, because when you see an 815% climb on a penny stock discussed on Reddit, your immediate assumption is, okay, this is pure meme stock manipulation.
Pump and dump.
Exactly, but reading through the thread, these traders are not just spamming rocket emojis, they are publishing these deep dive fundamental analyses based on very real commercial partnerships.
We're essentially witnessing the moment when a geopolitical policy tailwind perfectly aligns with a commercial megatrend. The retail excitement isn't solely based on European government subsidies. It's being violently amplified by the global artificial intelligence boom.
Yeah, a huge part of the Reddit thesis revolves around the specific commercial deal. A user points out that Sivers is collaborating with Jabil, which is a $20 billion contract manufacturer.
Massive company.
Huge. Sivers is supplying lasers for a 1.6 terabit optical transceiver module, which is basically a piece of hardware built specifically for next-generation AI data centers.
And the mechanics of artificial intelligence really explain why this hardware is so incredibly critical. Because massive AI compute clusters, they have to process unfathomable amounts of data continuously. Right. And traditionally, all that data moves through copper wires. But at the scale that AI requires today, pushing electricity through copper generates immense amounts of heat and consumes prohibitive amounts of power. It creates a literal physical bottleneck.
So the physical limitations of copper are actually holding back software development right now.
Exactly. So the industry is desperately pivoting to photonics.
Using pulses of light.
Right. Using pulses of light instead of electricity to transmit the data. Light offers incredibly high bandwidth with nearly zero latency and, crucially, dramatically less heat.
But creating those light pulses is hard.
Extremely hard. It requires highly complex indium phosphide lasers. And indium phosphide is notoriously difficult to work with and manufacture at scale. But Sivers specializes in exactly this material.
This maps out the collision perfectly. The European Union desperately needs sovereign control or photonic supply to secure their defense and aerospace industries. While simultaneously, the global tech industry desperately needs photonics to run their AI data centers without melting them down. Sivers is positioned right at the intersection of European defense paranoia and Silicon Valley AI infrastructure.
And retail investors are aggressively tracking the resulting commercial momentum from that. The Reddit thread zeroes in on another major catalyst, too, a confirmed LiDAR customer scheduled to start a production ramp in the fourth quarter of 2026.
And LiDAR is the technology autonomous vehicles and defense systems use to sort of see their surroundings, right? By bouncing laser pulses off objects.
Exactly.
The thread projects that this single contract could bring in anywhere from $28 million to $53 million over its life cycle.
And the scale of that projection is what's really driving the stock price, because Siver's trailing revenue was only $30.9 million.
Wow.
So a single new contract has the potential to almost double their entire revenue stream. And they've already demonstrated tangible business momentum, reporting actual 2025 revenue growth of 32.9% year over year.
So the traders are essentially functioning as like open source industrial analysts.
They really are.
They're mapping out this entire web of strategic partnerships, ONET Technologies, Enablance Technologies, Lionix International, and notably POET Technologies. One user even points out that Sivers supplies the underlying lasers for POET's high-speed products.
They're reading the exact same policy blueprints and supply chain reports as the gray suits in Brussels, but they are applying massive retail leverage to the outcome.
And there's always but with these things, the danger lies in how the retail market prices that anticipated outcome, right?
Oh, absolutely.
An 815% gain requires some profound scrutiny. Whenever a retail community confidently predicts a 10x return based on a mix of government policy and future commercial ramps, the underlying math usually reveals a very fragile foundation.
And looking through the Reddit thread, to their credit, they actually acknowledge a pretty terrifying bear case. The discussion points out that Sivers is currently trading at a price-to-sales ratio of about 20x.
Okay, let's pause on that. A 20x multiple. Give us the context for why that is so high.
Well, the average price-to-sales ratio for their direct peers is 11.5x.
Huh.
And the average for the broader European semiconductor sector is a mere 3.9x.
So they are trading at roughly 5 times the valuation of an average European semiconductor company.
Yes.
And a huge portion of this valuation is based on a production ramp for a LiDAR customer that doesn't even begin scaling until the end of 2026. I mean, this looks like retail investors gambling on the announcement of a policy rather than waiting for a proven, scaled business model.
The skepticism is highly warranted, because a 20x multiple is a valuation usually reserved for software companies.
Right.
Software has near zero marginal costs. Once you write the code, distributing it to 1 million new users costs practically nothing. But hardware is entirely different.
You actually have to build the stuff.
Exactly. Scaling up laser manufacturing requires buying physical raw materials, running incredibly expensive clean rooms, managing physical logistics. A hardware company simply cannot scale profits the way a software company does, which makes a 20x multiple uniquely terrifying for a manufacturer.
It basically assumes absolute perfection in execution. It assumes they will navigate that valley of death flawlessly.
Which perfectly echoes the explicit warnings embedded within the Eurochamber's document itself. The EU cautioned heavily against, quote, fragmented industrial efforts. Building a resilient, defense-grade semiconductor supply chain takes years of pouring concrete, calibrating sensitive machinery, and methodical testing.
Yeah, the physical reality of manufacturing is slow and grueling.
But the retail market does not have the patience for slow and grueling.
No, they demand immediate parabolic results. If a company is priced for perfection, the slightest delay in integrating that JIVBILA module or, a minor hiccup in the LiDAR production schedule will cause that 20x multiple to compress violently.
And the fragility of that valuation has already been tested. A Reddit user mentioned that a Swedish financial newspaper recently published an article that simply characterized Sivers as a meme stock.
Just that phrase.
Just that phrase. And the publication of that single word triggered an immediate 11% gap down in the stock price the moment the market opened.
That is insane. A multi-million-dollar swing in market capitalization based purely on a change in sentiment, completely detached from the physical reality of the company's actual manufacturing lines.
Completely detached.
Yeah.
Yet the retail traders seem to be doubling down. They are accumulating shares on U.S. brokerages like Fidelity, under the ticker SIVEF.
Right.
And they are aggressively banking on a U.S. NASDAQ dual listing expected in the first quarter of 2027. They're hoping that uplisting to an American exchange will unlock a flood of new capital and visibility.
They are playing a very high-stakes game of financial chicken with sovereign industrial policy. I mean, we are really watching the real-time financialization of global security.
We really are.
Decisions made in quiet rooms in Brussels to secure the continent's supply chain are immediately converted into highly volatile speculative assets by retail traders analyzing the ripple effects.
It's wild.
It is. So, to bring it all back, our journey through these sources started with Europe's harsh realization that the pandemic era plan to manufacture every chip in the world was basically economically doomed.
Right, they had to pivot away from sheer volume and embrace strategic indispensability, focusing entirely on complex choke points like photonics.
And the mechanism driving that shift is the new lab to fab strategy. By slashing bureaucratic red tape through GBER exemptions and injecting massive sovereign capital, they're attempting to manually drag European hardware startups through the valley of death and into commercial scale.
And when that massive government capital collides with the insatiable physical demands of the global AI industry, you get the chaotic reality on the ground. Retail investors aggressively capitalizing on this intersection, driving companies like Savers to mind-bending and potentially fragile valuations.
But, the structural shifts discussed in these documents impact far more than just day traders.
Oh, 100%.
The underlying technology of the next decade, the bandwidth powering global AI models, the sensors guiding autonomous vehicles, the secure communications protecting nations, all of it depends on whether this specific blend of policy and capital actually results in physical manufacturing.
Which raises a final, really provocative thought to consider.
Yeah, let's assume the European Union's grand strategy executes flawlessly. The lab to fab funding works perfectly, bypassing the bureaucracy, and helps companies like Sievers navigate the valley of death to become utterly indispensable to global AI and defense.
Okay, best case scenario.
Right. If they achieve that massive world-changing success, will these highly valued companies actually remain European?
That is the question.
Or will those astronomical valuations, the impending dual listings, and the infinitely deeper capital pools of the U.S. NASDAQ eventually lure them across the Atlantic? Because if Europe's multi-billion-euro quest for technological sovereignty merely serves as an incubator for companies that inevitably flee to American markets, then those chaotic day traders in the rocket t-shirts might be the ones truly dictating the future of the industry.